Good morning. Welcome back to the Financial Exchange. We're joined now by a special guest, Jenny Tang. She's the vice president and a research economist with a group over at the Federal Reserve Bank of Boston, and is going to be joining us for a few minutes now. Talk about the work that they're doing and some models that they've developed. Jenny, thanks so much for joining us. Appreciate it.
Thank you for having me on.
So, by way of background, Chuck and I talk about the Federal Reserve and meetings and Jay Powell frequently, but I think most people aren't really familiar with the work that, say, your group and groups at that the different regional banks do on a day-to-day basis. So can you kind of talk through your team and the type of research that you do with the Federal Reserve Bank of Boston?
Sure, of course. So my team at the Boston Fed, we support our policymaker, President Susan Collins, in preparations for the deliberations primarily at the FOMC meetings. We also do a lot of longer-term research projects to understand different topics in economics that are important for policymaking as well. And we are part of a department really that has several other groups focusing on different aspects of the economy, all with the goal of generating useful research and supporting the policy.
Jenny, when we talk about areas of research that are kind of front of mind for people right now, one of them obviously has to be inflation and any concerns about where inflation may go given the imposition of tariffs. When we talk about how you actually model inflation, can you explain to our listeners kind of what goes into that? Just because I think sometimes we get this feeling like inflation is something like physics where there are hard and fast rules, but it's much more nuanced. And I'm curious if you can give some insight into how you're approaching it these days.
Sure. So we've actually, in our team, recently developed a model of inflation, particularly focusing on the PCE inflation index, which is the one targeted by the Federal Reserve. And so one thing we saw, especially during the pandemic, and I think it's still very much an issue now in the arena of tariffs, is that you can have inflation coming from different sources. And in particular, I think it's especially important for policy to separate out inflation that's due to demand versus supply. And the reason for this is because demand-driven inflation tends to move together with employment so that the two objectives of the Federal Reserve System, the stable prices and maximum employment, are not at odds. But when you see supply-driven inflation, as we did during the pandemic and as we potentially might due to tariffs, that usually comes with slower activity. So taming this type of inflation to achieve our stable price goal would generally require slowing employment below the maximum employment goal. So this generates a policy trade-off. And so we developed a model to kind of separate out the different sources of inflation to help better inform policy.
Jenny, when you look at things like expectations, we just got the University of Michigan survey out a little bit over an hour ago. How important do you find consumer expectations for inflation to be these days compared to, say, in previous times, or are they never really heavily weighted in your models?
So they definitely played a much larger role during the high inflation period of the 1970s. Over time, I think, maybe I'm biased, but I think largely due to good policy and the Fed being able to establish credibility in controlling inflation, they have played a lesser role. They've subsided. During the pandemic, I think we saw, just a tiny hint of expectations being a little bit wobbly and contributing just like a hair more than in the past. But really, expectations stayed well anchored, they stayed stable, and they're not, I think, currently a big factor in inflation.
Jenny, one of the things that we saw yesterday was the CFO of Walmart indicated that they would start having to pass through tariff-related price increases in the coming weeks. So obviously when the biggest or one of the biggest retailers in the country says that, we take notice. Mm-hmm. Most people don't work for the biggest retailer in the country. Even in the retail space, there's a lot of small and medium-sized businesses that still import a ton of their products that they sell here in the U.S. what kind of insights do you have as to how those smaller businesses may end up either absorbing or passing through the tariff costs to their customers?
Yeah, I think that's definitely an area that we're very interested in. These smaller businesses, they're an important kind of growth engine in the economy. They generate a lot of employment. They also are a type of business that we don't have a lot of visibility into in terms of publicly available data. And so at the bank, in collaboration with Morning Consult and some other academic researchers, we developed some survey questions that we fielded towards the end of last year to try to understand how tariffs were affecting these smaller businesses. And we did indeed see in our survey methodology that there was a causal effect of tariffs on essentially raising the cost expectations of importers and their price expectations as well, that they would have to pass along some of these cost increases to their customers. With non-importers, less so. Interestingly, there we actually saw that their cost and price expectations were slightly going down, which could reflect an expectation of lower demand, possibly.
Jenny, when you take a look at the regional economy of the New England area, which the Boston Fed obviously covers, are there any regional differences you're seeing in the state of employment or in the state of inflation and expectations compared to, for instance, areas where housing inventory is up significantly or unemployment picture might be changing more rapidly than, say, in the greater Boston region?
I think currently we're seeing a lot of what the same kind of thing that we're seeing across the country. And that could be in part because the most kind of salient thing affecting the country right now is a more national issue of these import tariffs. I think longer term, we might start to see some other dynamics that New England stands out for. In particular, we may see the effects of things going on in the education sector, for example, impacting us more as, we're kind of, that's a big sector for our economy. Similarly, we may see some immigration policies start to affect some of the sectors that we have here a bit more in terms of like tourism. You think of Cape Cod, places like that.
Yep.
I know that inflation obviously is front and center, as we discussed, with people nervous about what could happen from a tariff implementation standpoint. But the other piece that the Fed is obviously focused on is employment, and we talk about this idea of full employment fairly often, and how it relates to how the Fed may manage policy and what it means for average Americans. Any thoughts as to how the idea of full employment may have evolved into where, look, we've been sitting near 4% unemployment for a couple years now, which is, lower than I think most economists would have been comfortable with for, the last 40 or 50 years. Any thoughts as to how that may be evolving in the idea of full employment?
Right. I think this example you bring up of we've been sitting with 4% for a long time is a good one. I think the notion of what unemployment rate constitutes full employment is really something that evolved quite a lot over time. And this has to do with more structural factors like how our industries are organized. We used to be much more manufacturing heavy, and now we're a more service heavy economy. So things like that. It can also be influenced by demographics, the educational makeup of the workforce. And so this is something we expect to evolve over time. I think in this notion of maximum employment, a lot of people also like to think of maximum sustainable employment. And so we've learned over time, especially in the time like before the pandemic, that we can be at unemployment levels that are very low relative to historical standards and still have that seem sustainable in the sense that the employment itself, the labor market itself, is not really contributing to inflationary pressures. And so this measure of full employment based on unemployment rates is something that we certainly do monitor a lot over time and try to estimate over time.
Jenny, that's all the time we have, but wanted to say we really appreciate you coming on. This was very informative, and we'd love to talk to you again sometime soon. So thank you so much for joining us today.